Hello traders, join us in this video as we discuss the best approach to trade the United States dollar and Japanese yen currency pair. We begin by highlighting that Forex traders have to always remain vigilant when trading this pair, particularly when it trends in one direction for an extended period. This way, you'll not be surprised by the market when the Bank of Japan makes interventions to stabilize the Japanese yen. The United States dollar Japanese yen currency pair, which is a pillar of the Forex market, provides market participants a confluence of liquidity, volatility, and economic significance. This pair, which represents the exchange rate between the United States dollar and the Japanese yen, is a favored instrument among Forex participants due to its deep liquidity and tight spreads. The USD Japanese yen pair is heavily influenced by economic policies and macroeconomic indicators of both the United States and Japan. The Federal Reserve, that is Fed, and the Bank of Japan, BOJ, play pivotal roles in shaping the pair's movements. Typically, the Fed's monetary policy, particularly its interest rate decisions and quantitative easing measures, directly impacts the strength of the United States dollar. Conversely, the Bank of Japan policy stance, which is characterized by ultra-low interest rates and periodic interventions in the forex market, influences the Japanese yen value and its movements. As such, traders must closely monitor policy announcements, economic data releases, and speeches by central bank officials so as to gauge potential shifts in the pair's trajectory. Economic indicators such as gross domestic product, inflation rates, employment data, and trade balances from both countries are critical in forecasting the movement of the USD Japanese yen movements. Typically, strong GDP growth and rising inflation rates in the United States bolster the US dollar, while Japan's economic performance, often marked by deflationary pressures and modest growth, can lead to the depreciation of the yen. However, the yen's status as a safe haven currency adds complexity. During times of global financial turmoil, investors flock to the yen, driving its value higher despite Japan's economic fundamentals. This pair also exhibits correlations with various financial assets and market sentiment. It often mirrors the movement of the US Treasury yields, with higher yields attracting foreign investment in the United States dollar. Additionally, the pair is inversely correlated with gold prices. Typically, a strengthening of the United States dollar tends to suppress gold prices and vice versa. At the same time, equity markets play a vital role. A positive risk sentiment generally weakens the yen due to diminished demand for safe haven assets. Understanding these correlations allows traders to anticipate the United States dollar versus Japanese yen currency pair movements by analyzing the broader financial market trends. Liquidity in United States dollar Japanese yen market is typically unparalleled, making it an attractive choice for traders seeking to execute large orders with minimum slippage. The pair's trading volume is concentrated during the overlap of the Tokyo and London session as well as the London and the New York session. These periods provide heightened volatility and trading opportunities, with the Tokyo session particularly being important due to the active participation of Japanese financial institutions. As such, traders should be aware of these temporal dynamics so to optimize their entry and exit points. We have to note that technical analysis is indispensable for trading the United States dollar Japanese yen currency pair. Key levels of support and resistance, which are identified through historic price action, guides traders in setting stop loss and take profits orders. At the same time, Fibonacci retracement moving averages trend lines are widely deployed to discern potential reversals or potential reversal points and trend continuations. We also have to note that fundamental analysis have to be taken into consideration, and combining the technical tools and fundamental analysis enhances the robustness of trading strategies. At the same time, risk management is paramount when trading this currency pair, given the pair's volatility, especially during major economic releases and geopolitical events, as well as during interventions by the Bank of Japan. Traders must employ strict risk controls. Position sizing, diversification, and use of stop-loss orders are essential to mitigate potential losses. Traders should also be cognizant of leverage, which, while amplifying potential gains, equally magnifies potential risks or losses. One of the distinctive features of the United States dollar versus Japanese yen currency pair is the practice of carry trading. This strategy involves borrowing funds in low interest rate currency, particularly the Japanese yen, to invest in higher yielding assets denominated in the United States dollar. The interest rate differentials between the two countries, or rather the two currencies, generate positive carry, attracting traders seeking steady returns. However, carry trades are sensitive to interest rate fluctuations and market volatility, necessitating vigilant monitoring and timely adjustment to positions. The geopolitical landscape also exerts significant influence on the United States dollar versus Japanese yen currency pair. Tensions in the East Asia, particularly involving North Korea, can spur safe haven flows into the yen. Conversely, United States political development, trade policies, and international relations impact the strength of the United States dollar. Traders must therefore stay informed about geopolitical development and assess their potential impact on the pair's dynamics. Also, market sentiment and behavioral finance principles are integral to understanding United States dollar price movements. Sentiment indicators such as the commitment of traders report and speculative positioning data reveals the market collective outlook and potential inflection points. Behavioral biases such as herd mentality and overreaction to news events can create short-term trading opportunities. Savvy traders exploit these psychological factors to anticipate market reversals and capitalize on inefficiencies. Technological advancements are also deployed when trading this currency pair just as other currency pairs. Typically, the United States dollar versus the Japanese yen currency pairs rich history and economic significance makes it a staple in Forex traders' portfolio. As such, mastering its intricacies requires a blend of fundamental analysis, technical expertise, and strategic foresight. Traders must remain vigilant, continually adapting to evolving market conditions and leveraging their knowledge to identify profitable opportunities. Thank you for watching. Let us interact again in our next trading video.